Welcome to This Explainer. We are jumping right in today because we're cracking open a massive 30-question toolkit designed to completely decode all that confusing stock market jargon and seriously elevate your financial literacy. Look, if you've ever felt totally overwhelmed by the endless sea of charts, ratios, and acronyms, you are exactly in the right place. We're going to pull out the core wisdom from a fantastic set of foundational questions to help build your ultimate investing toolkit. Let's get into it. Here is our quick roadmap for today. We'll be hitting 1. Two approaches to investing. 2. Reading the price charts. 3. Market trends and indicators. 4. Measuring company financial health. And 5. Key valuations and ratios. All right, let's kick things off with Section 1. 2 approaches to investing. So we have to start with the ultimate investor dilemma, right? How do you actually know what to buy? And maybe even more importantly, when to pull the trigger? When you look at the market, it's just so easy to get completely lost in the noise. Prices are jumping every single day, headlines are screaming at you, and literally everyone has an opinion. But successful investors, they don't just guess. They rely on structured analysis to figure out a stock's true potential. To cut through all that noise, investors generally lean on two main complementary ideologies. It's kind of like looking at the exact same puzzle from two different angles. On one side, you have technical analysis. This is all about studying price charts to pinpoint the absolute best entry and exit points. It's basically the science of the when. On the flip side, we have fundamental analysis. This focuses on the what, studying a company's financial health, looking at GDP, and sizing up the management team. It's entirely focused on the actual underlying business, not just what the price did yesterday. Moving right along, let's open up Section 2, reading the price charts. You know those jagged red and green bars you always see flashing across financial apps or on the news? Yeah, those are candlesticks. But what are they actually telling us? Are they just, random shapes, or is there a hidden code in there? Well, a single candlestick is literally packed with data. It gives you the opening price, the high, the low, and the closing price for that specific time period. It's a perfect little snapshot of the battle between buyers and sellers for that exact moment in time. And hey, the colors aren't just for decoration. A long green or sometimes white candle, that means buyers were stepping on the gas. They were in absolute control, pushing the price straight up from the open to the close. Conversely, a long red or black candle screams intense selling pressure. The sellers completely dominated, dragging that price down. Now, as you start stringing these candlesticks together, patterns start to pop out. Traders use these to find their entry and exit points. Two concepts you absolutely need to know are support and resistance. Think of a support level as a floor. It's a price where the asset finds it super hard to fall below because buyers keep rushing in to buy the dip. Resistance is the exact opposite. It's a ceiling where the price struggles to break through because sellers take over and start taking profits. These floors and ceilings create some pretty recognizable shapes. Take the W and M patterns, for example. The visual nature of these letters tells you the story instantly. A W shape traces a double bottom pattern, meaning the price slammed into that support floor twice, held strong, and bounced up. An M shape is a double top. It hit the resistance ceiling twice and got rejected, which usually hints that the price might be heading south. Zooming out a bit, let's hit Section 3, market trends and indicators. The market is basically one giant, never-ending tug-of-war between two main trends. The bullish trend means optimism is running high and prices are marching upwards. On the flip side, a bearish trend means pessimism is taking the wheel, driving prices down. Understanding which of these macro trends you're actually swimming in is absolutely crucial before you make a move. But here's the thing. How do you even spot the trend when daily prices are jumping around like crazy? That is where a moving average comes in. Traders use this tool to calculate the average price over a set number of days. It magically smooths out all that jagged, volatile price data into one clear, continuous line, making the true direction of the market way easier to see. Now, when you combine a couple of these averages, the signals get really powerful. If a short-term moving average crosses above a long-term one, boom, that's a highly celebrated golden cross, usually suggesting a new bullish trend is taking off. But if it dips below, well, that triggers the dreaded death cross, which signals a potentially nasty bearish downturn. Another massive tool for the technical toolkit is the RSI, or Relative Strength Index. Think of this guy as the stock's momentum speedometer. It points out overbought or oversold levels. If the RSI revs past 70, the asset is typically considered overbought. Basically, it might have rallied a little too fast and could be due for a breather or a pullback. Okay, time to switch gears entirely. Section 4, Measuring Company Financial Health. If you really want to look under the hood of a business, you have to ask, where do you find out if actual cash is moving through the company? I mean, a business can look fantastic on paper, but if real money isn't flowing in and out properly, that business is not going to survive very long. Well, here is your treasure map to a company's health. The balance sheet shows you exactly what they own and what they owe. The profit and loss statement reveals if they're actually, making a profit. And to answer our question, the cash flow statement tracks the real-time heartbeat of money actually moving in and out of the building. So, what are we actually looking for in these documents? Well, first, you want strong liquidity, meaning their current assets easily cover their current liabilities. Second, we measure that exact ability to pay short-term bills using the current ratio. Third, you want to make sure they aren't totally drowning in debt, which you'd spot with a high debt-to-equity ratio. Oh, and remember, the sector always matters. Banking and NBFC sectors, for example, are incredibly sensitive to interest rate changes. Finally, let's bring it all together in Section 5, Key Valuations and Ratios. This is where we translate all that health data into actual math to find a stock's intrinsic value. EPS, or earnings per share, is literally your slice of the profit pie. Dividend yield tells you the direct cash return you're getting. Book value exposes the raw net worth of the company per share. And ROE, or return on equity, shows you exactly how efficiently management is using shareholder money to grow the business. These specific ratios are kind of like a financial lie detector. For instance, a low PE, or price-to-earnings ratio, usually means the stock might be undervalued. You might have found a bargain. Conversely, a high price-to-book ratio often suggests the stock is currently overvalued compared to its actual net worth. Which brings us to the million-dollar question to wrap up this explainer. Now that we've dumped this whole toolkit on the table, the charts, the statements, the indicators, what's your play? Are you going to be a pure chartist hunting for golden crosses, a fundamental sleuth tearing through balance sheets? Or are you going to merge both of these powerful approaches to completely maximize your edge? The choice is entirely yours, and the market is waiting. Keep learning, keep analyzing, and we'll see you next time.